Tony. Tony is a veteran of our industry, and I love listening to him. In fact, it probably shortens my own presentation because some of the things he's mentioned come up in my presentation on the new fund that we're launching. I'm here to tell you about a new fund, a first of its kind, Section 65 approved, available to South Africans. In an industry that changes very little, it is really, really exciting for us at Counterpoint to introduce to you something that you haven't seen before. It's the Counterpoint Global Owner Managed Flexible Fund. And if you look at the screen, take a look at the brands. Take a look at the brands that you see and the businesses that you see, and ask yourself this question: have you interacted with any of these at least once today? If you look at the last year, or even 3 years, you probably interacted with most of these brands. And if you're younger, I think you definitely touched on Monster. They're wonderful brands, they're incredible businesses, they've changed our lives. But they have one thing in common that's not obvious from the slide. What they have in common is that at the helm of the business is someone who's not only a founder or a second or third generation of the original founder, but they're also running the business and they own a significant investment stake. And we're talking big money. As you can see on the slide, Bezos is over 100 billion worth. For those of you who follow the story, you know that at some point he was closer to 150 billion. McKinsey has taken a big chunk of that, which he still gets to vote. And just this week, a few days ago, LVMH founder Bernard Arnault is now also in that $100 billion club in terms of his equity, his shareholding in the company. So what you have here is you have these phenomenal individuals who have a huge amount of equity in the business, and they're still running it and influencing the strategy. These two factors on their own, a profitable company, a strong brand run by an owner-manager that has a significant stake, is a strategy that works. It's very compelling. What this line shows you, we've gone back at Counterpoint, and we've gone back in our history even to the early 90s, but we've only shown you from 1998. An equally weighted strategy of the stocks that meet our criteria has massively outperformed the MSCI World. So there's academic evidence. We've shown you some of it. People who sit in their ivory towers in academia, what they've done is they've looked at it and they've said, this works. It works for a whole lot of reasons, which I'll tell you about later. But the combination of that works, and we are trying to run a fund that takes advantage of that very point. Why does it work? Earlier, Tony spoke about using common sense. Instead of putting valuation ratios and a lot of industry speak or jargon, let me give it to you in common sense words. And anyone who's sitting here in this room who is a business owner will know that this makes sense. If your capital is in the business, and it's your business and you care about it, you do something incredible. You're really thinking about the long term. You're generally very opportunistic, and if something's not working, you try to get rid of it. You're trying to create wealth because this is your vehicle for creating wealth, not just for you, but also for your family, for future generations. It is your legacy. And the reason it works is, it's an American term, but it makes sense. You have skin in the game. It is your business. So this is a common sense reason why these businesses work. What we've done is we've looked at the entire universe of stocks in the MSCI. Now earlier Tony spoke about his strategy on his fund, and he looks at the MSCI World. We say that we literally, almost as though we're taking spectacles, we're putting them on, and we're tilting them and we're putting a different lens on it. We're saying the entire universe of equities in the world is made up of only two types. Owner managers that meet our criteria, and I'll tell you a bit about that criteria, and those that don't. So we eliminate quite a few stocks that don't meet our criteria. And in the end, we have 250 stocks that we can invest in. The fund itself is not 250 stocks. The fund is really our best ideas of somewhere between 50 and 70 stocks. But we start with 250. What's the criteria we're looking for? They're threefold. The top one is personal wealth and ownership. They really need to have a lot of money. And you don't get this on a Bloomberg screen. For those of you who know, in our market, we look at Bloomberg's screens all the time. You really have to look at their personal wealth. And there's a host of different sources that we look at. But the minimum that we're looking for is $400 million worth of personal assets. Once they have that, we're looking for a quarter of that, 25% of equity in the very company that we're interested in. So in the case of Facebook, Mark Zuckerberg clearly has over $400 million worth of net worth, and his stake in Facebook is worth more than $100 million. So we're looking for wealthy people. Why? Why are we focusing on the independently wealthy? There are two reasons. Once you've acquired wealth, your attitude towards risk typically changes. You're not someone that started out and you're taking a shot. You're really into speculation, hoping to make it big. You've acquired the wealth, you want to protect that wealth. The second reason is that if you're wealthy, you have access to capital because you've achieved so much, and you have access to information. You have an informational network of people that only the wealthy can know. It's a fact of life. It seems unfair that the wealthy have that network, but it is a fact, which means that you can get opportunities. The next thing we look for is we're not interested in startups. We don't want to invest in things that are speculative and small. We're looking for businesses that have been listed for at least 2 years. We'll come back to this point again. They need to be listed for at least 2 years. It comes through later in this presentation, and it will make sense to you when we get there. But at the same time, we're not really trying to invest in closed-end funds or investment trusts, and there's definitely not a single ETF available for the strategy. It is unique in South Africa as a Section 65 approved fund. It's, we believe, unique in the world, and there is no ETF available. So Counterpoint is your only source for a fund of this nature. The final point is we want to be able to buy and sell the shares fairly easily, which is not really a problem because the global universe is so wide and the stocks are so liquid. When we put the portfolio together, we get to the 250 and we put them in the portfolio, 50 to 70 names, we find an absolutely remarkable thing. We still have a global portfolio. We have a portfolio that has its revenues all over the world, and we have diversification not across geographies only, but also across universes, sectors. And there are various revenue streams that we can get. The main reason that we do that is owner-managers are the same, whether they're sitting in Kazakhstan or New York or Los Angeles. It's their business, it's their capital, they're doing the same thing. Even though they don't speak the same language, the language of business and the language of money and creating wealth is the same. Now I'm going to go through this really quickly because Tony's already made the point. But I wanted to just give you the context, the global context on trends. There are a few trends that are happening in the world, and it will be very brief. The first is that if you look at internet usage, recently, there's the Internet Trends by Mary Meeker. It's just come out. It's a report that comes out every year. And we can't, I always look forward to it because it gives me a good sense of where things are going. So, of all the people on the internet, 30% of them are using Facebook at least once a day, as we currently speak. You can see the trend. You can see that YouTube usage has gone up in a very short time over the last few quarters. And Instagram usage is going up. But if you look across the room, I'm pretty sure that you have used at least one of these today. If you have, you will notice Facebook owns WhatsApp and Instagram. It's an owner-manager. Owner-managers are at the forefront of the changes as they're happening. Google owns YouTube, and the rest is history. There's Twitter. Let me go to the next slide. We've seen this before, but it's the same point. In 2010, most of the time was spent in terms of people's access to the media, was spent not on their mobile compared to television. In the short space of 8 years, most of us are spending more time on our mobile devices. Even today, even while I'm speaking, I'm sure some of you are looking at your phones. That's okay, because that's what the world's become. 10 years ago, or 8 years ago, advertising spend was lagging, as you can see. That's the blue line. But it's caught up, because people have finally worked out that digital advertising is the future. The businesses that have been at the forefront of this change have been Google, Facebook, Amazon, Twitter, and it continues. I'm expecting this trend to continue. Why am I putting up the slide? I'm putting up the slide because owner-managers have to be at the forefront of change. Because if you own the business and it's your capital, if you are lagging, you can't resign and take a job at another company. You can't say, oops, sorry, that's in my CV, it's a job I had. While I was there, it was really going well. I moved to this next company, I moved to another industry. This is your business. So it's your business to be on top of it. And generally, they're able to make those changes quicker, faster, and they're able to experiment. This is a very busy slide, but it tells you what's happening in the media world. This entire industry has already been disrupted massively. It's a big industry, given the size. But over the next 10 years, all of these businesses will change because streaming and video streaming, you've seen it with Disney. Disney is now competing with Netflix. It's building a business that will compete with Netflix. The world is changing and owner-managers are at the forefront of it. Why am I telling you all of this? I do not know what lies ahead in the next 10 years. I don't know what lies ahead in the next 2 years. I'm not sure how cryptocurrencies will develop. I'm not even sure if Facebook's recent strategy with Libra will be successful. The point of the matter is that the owner-managers with their own capital at risk, they go to bed every night. And while you're sleeping, they're thinking about how it's going to change. When you wake up, they have a solution. They're trying things, and they will be at the forefront. It's the old legacy businesses run by agents, CEOs, and leaders that will lag behind because they'll miss the boat completely. Now, we've gone across the country in the last month or so because it's a new fund in terms of launch. It's just recently been launched. But it's not a new fund in terms of our strategy. For the last 8 years, I've had this strategy in my thoughts. I go to bed at night thinking about it. I was basically praying that no other person would come out and launch the fund. So the point is that we've started to do it. We've done it in portfolios for 8 years. We have actual experience at Counterpoint. The fund is really a culmination of 8 years of actual experience on my part and 3 years of experience at Counterpoint. When we went around and telling people about it, everybody gets it. They understand it, and they want it. They want it because, firstly, it's different, and two, it makes sense. It makes absolute sense. We have a few frequently asked questions that every single person has asked us. So I'm going to go through them now, and I'm going to tell you a few stories as I answer them. The first is, if you can tell us one stock that explains the strategy. If we wanted to tell anyone why we're in this fund, and we had to give one example, what would that be? The next one would be, since you looked at it for so long and you studied it, tell us the one idea that has made you the most money ever. Of course, some of you have already noticed that all of the faces with all the money, they're males, older males that have achieved it. We are the women. We are the females. Are they not running businesses? Why are they not on the list? And then, I've been telling you what we do, but I probably haven't told you what we don't do. And then, what's the next big thing? Because clearly 10 years ago, the next big thing was the move to mobile and digital advertising. So let's go. Thanks to Tony, I don't have to say much. This is the stock that you can always use as an example of an owner-manager that works. Starting in the 1st of January 2000, that is before the dot-com crash, Amazon has still given you 17.8% per annum up till very recently. That's a phenomenal return. Why have you done that? You've done that because this man has had a vision. And his vision says the customer first. And if we do what the customer wants, then we will invest in what the customer wants and we won't look at our competitors. We will evolve. We will adapt. We will think long term. And every single day is day one. He's paranoid because he says, even though we're this big, today is day one. Which tells you everything that you need to know about an owner-manager. It's Amazon. It's in our fund. And I can understand now why Tony has it in his fund. It turns out the best stock that you could ever own is called Monster Inc. And for those of you who don't drink Red Bull and you drink Monster, it has had monster returns. So let me tell you what the slide says. So on this day, in June 2004, the stock had already been listed for 11, 12 years. But it was tiny, and it was growing, and it was small, but it was growing every single day. In fact, up to that point, you made 27% per annum in the stock. The business was growing, and the share price was following. It was taking market share. It was captivating people's minds, and it was everywhere. Of course, on that date, it finally met our criteria. Because remember I said it had to be listed for 2 years. It had to have a certain size. The person who started the company had to have certain net worth, and so on and so on and so on. Of course, on that day, you'd say, well, guess what? By the time you came in, it's over. This is now a 12-year idea, and it's the end. You've made your returns. You might as well pack it up, because just as this thing becomes the only manager that you want to invest in, it will start lagging. Well, guess what? It didn't. That's when it really took off. Until that point where they reached a peak valuation and we were able to sell the stock. We own it again. It's now 1% of our fund. It's never going to be more than 3%, even if we find it attractive, because of our rules of how the fund is built up. But we like it. The gender bias is real, but we didn't cause it. We love female CEOs and founders. We're looking for them. We want them. We want to invest alongside them. We are indifferent. We think as long as it's an owner-manager, we have no gender preference whatsoever. If it's an owner-manager running a great business, meeting the criteria, and the business is attractive to us, we'll invest in it. We have found one. And believe it or not, we followed it long before it started being listed. We followed it before, because the venture capitalist that supported the fund, when the company, when it started in 2011, is someone that I follow. I follow him, and I think he's a phenomenal investor in startups. So I knew about Stitch Fix. I knew about Katrina Lake. She finally listed the business, and in November this year, it will be 2 years. At that point, we will be able to invest in Stitch Fix based on our criteria. So today as we speak, even though we like it, the business meets our criteria, she meets our criteria, but it hasn't been listed long enough. It is our rule. We want the company to have proven itself, because being listed for 2 years means it's under the scrutiny of public markets. And we want to see how the actual returns come through and how the profitability comes through. What does this business do? What it does is it says, if you sign up with us, you pay us a fee, and then we give you a personal stylist based on the data that you give us. Our business is all about data science and personal stylists, and then we send you 5 items, mostly apparel. It started with clothing, but it can just as well be footwear and accessories, which we'll send to your home, and we will, if you like it, you keep it, and if you don't like it, you send it back. It has been an incredible hit in this new digital world, because it turns out that not only are they getting more and more new clients, their keep rate is very high, because clients, whatever they send the client either keeps all of it or most of it. The data that they get from the client there's a data science behind it, because it tells you what the client likes, what the client doesn't like, how they're buying, and the client's buying more frequently. So Stitch Fix is a phenomenal business. We love it. We think it's only the beginning. They have something called the Style Pass. And I have to stop now, because I'm so excited about this business and the way it will capture the imagination of customers, not only in America where it started, but now they're in the UK and elsewhere. You can do your own work. Why don't you go and Google Stitch Fix today? And maybe you want to sign up. But Katrina Lake is definitely on her way to being one of our owner managers. What don't we do? Now I'm going to borrow something from what Tony said earlier. Every single stock, there's a picture. We form a picture ourselves about the business. What don't we do? The first thing we don't do is we don't invest in anything, even if it meets our criteria, where the picture doesn't add up. Where the numbers don't add up, The whole picture doesn't add up and we can't trust. Elon Musk is a South African, and we would dearly love to have him as our owner manager, and he does meet our criteria. But we do not consider Tesla worthy of our investment. I'm not going to go into the detail, but we don't do it. The bottom line is we don't trust it. And that's all I can say right now. Recent IPOs, Beyond Meat, Uber, and Lyft are phenomenal businesses, and they meet our criteria, but they haven't been listed for more than 2 years, and we want them to be profitable. We want some level of profitability before we get involved, but they have potential because we will invest in them. What's the next growth area? There's a lot. I decided to focus on only one. We follow the money. The owner managers that we invest in are willing to make long-term investments in areas of growth. Just like Bezos invested in AWS long before people knew about it, we are following the money. They're playing the long game in India. Now, India is really a phenomenal example of what South Africa could be. And many of these owner managers that we invest in, KKR, Fairfax, and Brookfield, have been in India for 15 years already. And they've only invested since 2014, when Modi was first elected. They are now ramping up their investment. I want to say that India is a growth story built on the foundation of technology. It is not an infrastructure one. It is not technology infrastructure, yes. But it's not something that is similar to what China has done in the past, where they're effectively trying to build big capital expenditure. It's built on technology, and it will work, and when it works, it has legs. So we think India is a great opportunity, and we will continue to follow our owner managers into India in every single area where they invest. I'm almost coming to an end. This is my last 2 slides. Why invest in the fund in summary? Firstly, it works. The strategy works. There's a built-in risk control because it's your money with their money. And because the owner managers are managing their own money, you don't have to worry about it. They eat, sleep, drink, wake up, thinking about their money, and you are just a partner with them. It gives you access to global growth. It's diversified. We have access to all the different sectors. We have no big exposure to any one sector or geography. And we have cash flexibility. So this fund is simple. It's owner-managed equities plus cash. And if we think things are getting frothy in markets, we will have a higher cash buffer. And if we think it's time to invest, we will have less cash. And the signal from the owner managers themselves tells us quite a bit. And one of our big holdings, Berkshire Hathaway, Warren Buffett, who's thankfully still alive, he has more than 100 billion of cash on his balance sheet. And if he has cash on his balance sheet, I think it's only right that we should have it. This is my final slide. If you invest in this fund and invest alongside these owner managers, we welcome you to take a seat at the board table, because that's what it is. It's just as much your business as it is theirs. And in the words of Bezos, it's the closest thing to private investing in public markets. And the only fund that you can do that in as a South African is the Section 65 approved fund by Counterpoint. Thank you very much.